In this video, we will talk about market order versus limit order, so make sure to watch the full video. In the dynamic and complex world of financial markets, where every tick of the clock can impact trading outcomes, traders employ a diverse array of strategies to navigate the intricacies of buying and selling assets. At the heart of these strategies lie two fundamental tools: market orders and limit orders. This in-depth exploration aims to unravel the nuanced differences between these order types, shedding light on their characteristics, applications, and the strategic considerations that guide traders in their quest for successful market navigation. 1. Market orders. The need for speed. Overview of market orders. Market orders represent the essence of swift and immediate execution. Traders issuing a market order seek to buy or sell an asset at the prevailing market price, emphasizing speed over precision. Execution speed unleashed. Market orders are engineered for rapid execution, designed to be filled instantly at the best available market price. The need for speed is paramount, making them the preferred choice in situations where timing is of the essence. Price guarantee challenges. Despite their agility, market orders come with a trade-off. The execution price is not guaranteed, subject to potential deviations from the displayed quote due to market fluctuations, especially in highly volatile conditions. Thriving in high liquidity. Market orders thrive in highly liquid markets, where the abundance of buyers and sellers ensures seamless execution. The high liquidity of such markets aligns with the swift nature of market orders. Navigating volatility. Traders often deploy market orders in the midst of rapidly changing market conditions, utilizing their immediacy to enter or exit positions swiftly amid volatility. 2. Limit orders. Precision in price control. Diving into limit orders. Limit orders introduce a level of precision into trade execution, granting traders control over the price at which their order is filled. Unlike market orders, limit orders wait patiently for the right market conditions. Exercising price control. The defining feature of limit orders is the granular control they offer over the execution price. Traders can specify the maximum price for a buy order or the minimum price for a sell order. The element of time. Unlike market orders, limit orders operate on a different time scale. They remain open until the market aligns with a specified price, or until the trader decides to cancel the order, allowing for strategic patience. Price guarantee versus execution time. While limit orders provide a degree of control over the execution price, there is no guarantee of execution if the market fails to reach the specified price. This delicate balance between price guarantee and execution time defines the essence of limit orders. Strategic role in range-bound markets. Limit orders find their strategic niche in range-bound markets, or when traders have specific price levels in mind for entering or exiting positions with surgical precision. 3. Choosing between market and limit orders. Strategic considerations. Understanding execution styles. Traders exhibit distinct preferences in execution styles, with some prioritizing speed and immediate execution, market orders, while others favor patience and price sensitivity, limit orders. Market conditions. The choice between market and limit orders is often dictated by prevailing market conditions. In highly volatile markets, where rapid execution is paramount, market orders may take precedence. In calmer or range-bound conditions, limit orders provide a more strategic approach. Risk tolerance dynamics. Risk tolerance plays a crucial role in the decision-making process. Traders with a lower risk tolerance may lean towards limit orders, appreciating the control they offer over the execution price. Market orders, on the other hand, expose traders to the risk of slippage. Aligning with trading strategies. The overarching trading strategy employed significantly influences the choice between market and limit orders. Scalpers and day traders seeking quick and frequent trades may opt for market orders. In contrast, swing traders or long-term investors may utilize limit orders for meticulous entry or exit points aligned with their strategic objectives. 4. Advanced strategies, blending market and limit orders. Hybrid approaches. Savvy traders often employ hybrid strategies, blending elements of both market and limit orders. This approach allows for adaptability, enabling traders to navigate diverse market conditions with a versatile toolkit. Conditional orders. Conditional orders, such as stop-limit orders, represent a fusion of market and limit order principles. These orders are triggered when the market reaches a specified price, combining the immediacy of market orders with the precision of limit orders. 5. Case studies, real-world applications. Market orders in action. Explore real-world examples where market orders were instrumental in capitalizing on swift market movements. Analyze the outcomes, considering the impact of potential slippage. Limit orders at work. Dive into case studies showcasing the strategic use of limit orders in capturing precise entry and exit points. Evaluate how these orders navigate range-bound markets with strategic finesse. 6. The evolving landscape. Technological influences. Algorithmic trading in market orders. Delve into the role of algorithmic trading in the execution of market orders, exploring how automated systems leverage speed for optimal results. Smart order routing and limit orders. Understand how smart order routing technologies enhance the execution of limit orders, ensuring optimal price fulfillment in dynamic market conditions. 7. Future trends. Innovation in trade execution. Decentralized finance, DeFi, and market orders. Explore the potential impact of decentralized finance on market orders, considering how blockchain technology might reshape the execution landscape. Automated decision support for limit orders. Anticipate future developments in automated decision support systems for limit orders, enhancing the precision and adaptability of these strategic tools. Mastering the dance of market and limit orders. In conclusion, the intricate dance between market orders and limit orders shapes the very fabric of trade execution in financial markets. Market orders prioritize speed and immediacy, while limit orders provide a meticulous approach to price control. The decision-making process between these two order types is a dynamic reflection of a trader's preferences, risk appetite, and the ever-changing conditions of the market. As the financial markets continue to evolve, the strategic interplay between market and limit orders remains a cornerstone for traders seeking success in the multifaceted realm of financial trading. The journey towards mastering the art of trade execution involves not just understanding these tools, but also blending them strategically to navigate the diverse and evolving landscape of financial markets. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.